and welcome to another market update from Horizon Investments. My name is Austin Fitch, and I'm joined today by our Chief Investment Officer, Scott Ladner. Scott, thanks for taking the time. Really excited to get into a conversation about markets. There's a lot going on. But first and foremost, I think what's on everybody's mind is the debt ceiling. We're coming up on it here in the next few days, week or so. Let's just give everybody our view on kind of where it stands, where we think it goes, and kind of what comes from it.
Yeah, look, I mean, where it stands right now is like nobody really knows. Today or later on today, Biden and McCarthy are going to get back together. They're going to continue to talk. It appears these things are going in approximately the right direction in a very haphazard fashion, which probably isn't that surprising. But at the end of the day, look, we are sort of with the market on this. Like the market is broadly saying we think this gets solved. We think it gets resolved in some form or fashion. Probably gonna be a little bit ugly. But that has to be your base case right now. I mean, it has to be the base case that these politicians aren't going to do something so drastically stupid as to put the economy off the rails, and they'll figure out some way to compromise and get together. That said, if that were not to happen, if this thing does go off the rails and we do have some sort of technical default, then we would expect a very violent reaction in financial markets because it is not in the price. At least in the equity market price. So right now we're proceeding along the path where we think it's going to get solved. We think we'll figure it out, but we are prepared and do have portfolios ready to trade into pretty quickly if we change our mind about that for whatever reason.
Yeah. No, Scott, that's a great point in terms of just all the moving pieces that are in play. But maybe taking a step back, if we think there are kind of two different scenarios that play out, but maybe base case is the idea that a deal does get done. If that's the case, maybe let's back up to what we talked about at the beginning of April. We talked about kind of three different scenarios on a go-forward basis for the market. And I think what we've seen over the last, let's call it month and a half at this point, is that kind of muddle through, right? We've been range bound. We've kind of gone sideways. But if there's that base case scenario where a deal does get done, does that tilt us towards kind of things getting better from here in your mind?
Yeah, look, I mean, I think the most likely path is still that we're going to do this muddle through idea that we did talk about a couple months ago. That said, we're seeing more signs on the good path than we are on the bad path right now. If you remember that the bad path involved a lot of things about tightening lending standards and impact on consumer spending and these types of things. We're frankly just not seeing very much of that right now. And part of it may be because U.S. consumers and businesses are actually pretty under-levered right now. So even if lending standards continue to tighten, it might be the case that people don't really need to borrow that much money and businesses don't need to borrow that much money. And so we are starting to see more of the signs like on the good path. And the good path, if you remember, revolved around the Fed stopping and pausing, inflation continuing to moderate, the fact that everybody in the world hates equity markets right now, like nobody wants to buy stocks. And so that entire narrative of, hey, listen, we think disinflation is more the theme for the rest of this year, whereas obviously it was inflation last year. And that we are seeing more signs of the disinflationary outcome and the resultant Fed pivot.
So let's unpack that a little bit. You talk about disinflation and kind of that really taking off. What does that do from a Fed perspective in terms of what we would expect them to need to do or have to do for the remainder of the year?
Yeah, look, I mean, I think it gives the Fed some flexibility and some freedom. We continue to expect them to talk tough. The market is not really pricing in many more hikes, maybe one more, and we would expect the Fed to want to continue to kind of talk tough to retain some optionality in their policy stance. But at the end of the day, they know that their policies act with these quote-unquote long and variable lags. And they've tightened policy by 500 basis points in about the quickest fashion possible, at least over the last 40 or 50 years. And so, it makes some sense at this point for them to maybe pause, take a breather. Let's assess the situation, see what's going on. We've just raised rates by an incredible amount in an incredibly short amount of time coming off the back of a pandemic. We probably don't understand all the dynamics at play here. And so pausing at this point makes a lot of sense to us.
Awesome. And we talked about a pause as part of that quarterly outlook. And we said if we get a pause, that actually could be really good for stocks on the back end of that. You touched on the fact that folks are actually severely underweight stocks right now. Maybe talk us through maybe the dynamics there and what that means if we get that rally, but folks are underweight. What does that look like for the back half of 2023?
Yeah, look, I mean, it is historically the fact, and this is something we talked about last quarter, historically the fact that when the Fed pauses their rate hiking campaign, the next 6 months are generally a pretty good time to be long stocks. You juxtapose that idea and that research with the fact that fund managers have about 30% of their general equity allocation. They've just very underweight stocks right now. Not only are they currently underweight stocks, but the proportion of managers that are planning on adding exposure to equities over the next 3 months is also at historic lows. Yeah. So, not only are people light positioned, but they're not really planning on to add to stocks here. And if you get that stock market rally that we think is going to start coming after the Fed is officially paused, you could get some FOMO kind of characteristics. And you get fund managers having to chase things. And that would just add fuel to an equity market rally fire.
Awesome. No, really appreciate the insight, Scott. Really appreciate everybody joining us today. As we've talked about, there are a lot of dynamics in play here. Don't hesitate to reach out to anybody on our team here at Horizon with questions that you may have. Happy to provide additional color. But like I said, really appreciate you listening in and look forward to talking to everybody soon. Thanks so much.